Welcome to the Weekly Spark, your fast 5-minute flash of insight into the world of mortgage and real estate. Every week, we're here to ignite your understanding of the market, from mortgage rates and housing trends to legislative updates and insider strategies. So let's strike the match and spark your week. This is the Weekly Spark.
God, I love that. It's awesome. I think we crushed it on it.
Awesome. You know what I love? Check this out.
Look at this.
New swag, guys.
New swag for C1M. I'm loving it, man. It's great. Where'd you get that? Just kidding. Awesome. Welcome to the Weekly Spark, for the week of 7/25/2025. Let's jump right into it, Jason. We've got a lot to cover, and let's make sure we are covering it. So the first thing I wanted to go through is the Japan tariff deal. Now, I kind of want to relate this back to mortgage and interest rates. So help me out with what this has as far as an impact on that.
Yeah, so listen, as the U.S. starts finalizing these tariff deals, that's going to lead to less uncertainty in the market. So as these trade deals get done, we're going to probably see some continued strength in risk on assets like the stock market, your 401ks, right, and the crypto market. But, generally speaking, when this happens, the 10-year treasury tends to rise, which will inch mortgage rates higher. And if we have time, we'll check the charts. But this is why most economists are pushing for a Fed rate cut, Ryan, like every other country seems to be doing right now. That'll help sustain and then eventually decrease mortgage rates over time. So as long as inflation continues to trend lower like it has been, I think we'll be in good shape.
Awesome. Yeah, we know we're definitely waiting on and hoping for some relief on the mortgage rate side. They just kind of keep inching up and making affordability even harder. So let's transition into a little crypto news here with Trump signing the Genius Act. I know we're both excited about this. So kind of lay it out for me and give us some insight.
Yeah, so big deal for all my crypto bros and gals out there, right? Because it gives crypto market some regulatory oversight finally on stablecoins. So if you don't know, a stablecoin is essentially a digital currency. It's pegged to the US dollar 1 for 1. So if you own $1 in stablecoin, you have $1. Well, why do we need a stablecoin? It allows for instant settlements. So you don't need a bank or need to make a transaction during banking hours. And it's a lot lower cost than a traditional wire. Eventually, this is going to trickle into all transactions, including real estate. So, a real estate purchase that can typically take, let's say, 2 to 5 days can be completed in minutes or even seconds using stablecoins. So, quick example, let's say a buyer from, Singapore wants to buy a commercial building in the US. You can settle funds instantly. You can avoid the international wire fees. It prevents wire fraud. It avoids time delays and not worrying about converting currencies over from like the dollar to the yuan or the British pound, for example. So it's exciting times.
Yeah, I think it's great. And I know that, you and I have talked about this. There's a Waldorf Astoria going in St. Pete, and they're taking their earnest money deposits in crypto. So they've utilized a third-party service for settlement, and they're taking those payments for the earnest money in crypto. I think it's fantastic for the market. I think there's another way to do it. And, eventually people are going to recognize like you can do it much cheaper and much faster than currently, in the banking industry. So may have some effect on the banks as well down the line.
It will become the standard for sure.
Absolutely. And then our last one. So this one is something we kind of discovered this past week, and I'm pretty excited about it because I think it's a really, really cool opportunity. Generally when we're doing a loan program, we've got, if you're a W-2 employee, you only get W-2. If you're self-employed, you only get to use those types of loan programs. Tell me a little bit about this blended income program and how it works.
Yeah, so this is great. Not many lenders or real estate agents really know about this program, but it's really a great way to close more deals. And it comes with a really cool feature. So, most realtors already know about the bank statement programs, right? Where your borrower can use 12 months of bank statements to show their total deposits. And then we can use an average of those deposits to calculate income rather than your traditional tax returns. And this is for self-employed or, 1099 buyers. But let's say your co-borrower is a wage earner like a W-2, but we need their income to qualify as well. So instead of having to use only your traditional W-2 income like a conventional or an FHA loan would, or a bank statement product, this product allows us to combine both the W-2 income on one borrower, and then we can also use the bank statement deposits for the other borrower. So this is just another way we can help a lot more buyers that most banks will automatically turn down.
Yeah, we've already utilized this after we figured it out, or after we found out about it, and it saved a deal, right? Like it was a deal that was a turn down from another lender, and we were able to save it because we knew about the ability to use both of those income types. So Jason, I'm going to jump to you. Let's go real quick into the charts because we didn't do it last week, and I want you to kind of take over from there and let us know what's going on.
Absolutely. So let's share my screen here. Let me know when that pops up.
Yep, I'm good to go.
Okay, awesome. So like we talked about in the beginning of the show, we are seeing the 10-year, to start with the 10-year US Treasury, it is creeping up some. Now, what I like to see is these are moving averages, and it is acting as a floor support here on the 100-day moving average. So it did dip down here with this kind of double floor here, right? You see a Fibonacci here and that moving average, and it is starting to trend upward. So, this is essentially not good for interest rates, but because we had that great downward capitulation, we're still in a pretty good area, and we do have some tough sledding to get through this other moving average. So when we go back to the bond market, so this is obviously where we want to see strength. We did see incredible strength. We saw this upward momentum, so it did kind of dip below these moving averages. We were getting a little bit, hopeful that it will hold, and it did. So it did kind of come up to this level here. But here's where we're at, guys. We just broke through this 25-day moving average, and we hit this Fibonacci ceiling. So we're in this really tight range here. So hopefully if it breaks over, we've got a lot of room to grow. We're talking about, maybe another 50 basis points here. So what am I advising my clients right now? So for the long term, I think we can wait this out and see which direction these bonds go. And if it breaks higher, we're looking at better interest rates.
Awesome. Hopefully we get some news in the market that kind of allows those interest rates to come true. And that's all we got this week. So we'll see you on the next one.
Thanks, guys. That's a wrap for this week's edition of the Weekly Spark, brought to you by Creative First Mortgage. If you've got questions or want us to cover something next week, please let us know, shoot us a message. And until then, keep your deals moving and keep your week lit. See you next time.